Hello everyone. Today we need to talk about a star stock, Micron Technology. If you've been following the US stock market recently, it's impossible to miss this company in the spring of this year, 2026. This stock shot up like a rocket, with its share price once breaking through the $400 mark. You have to realize that not long ago, at its 52-week low, it was only trading in the 60s. In just over a year, it has multiplied 5 to 6 times. Right now, mainstream Wall Street media, retail investors on major forums, and even some of your friends who know a bit about stocks are all talking about it non-stop. Everyone is saying that Micron is no longer the struggling old memory chip manufacturer it used to be. It has become been a core asset of AI infrastructure, wild pick and shovel play of the computing power era. And some people are even shouting a $600 price target. Doesn't that sound incredibly exciting? Don't it make you want to pull out your money and go all in right away? But friends, when we invest, especially as ordinary individual investors, making money is not easy. The thing we fear most is letting our own judgment get clouded just when everyone else has become greedy and lost their senses. So today, let us sit down, cut through all the overwhelming press releases and hype, and give Micron Technology a thorough buy-in health checkup, using plain common sense and the most fundamental business logic. We want to dive into dry financial tables or throw around jargon that leaves you confused. Think of this as a few old friends chatting in a tea house, pulling back the curtain to see what this business is really made of. First, let us do a classic thought experiment from value investing called the Bannon ownership test. Here, S, what it mean. Imagine you just won a massive lottery and have tens of billions of dollars in cash. You buy the entire Micron Technology, take it private, and lock it in a drawer for 3 years without ever looking at the stock price. Would that be a good deal? To answer that, we first need to understand what Micron actually makes money from. Simply put, it designs, manufactures, and sells memory chips, mainly DRAM and non-core flash. For more than 30 years, this business has been known in the semiconductor world as a brutal Dane, red ocean meat grinder. Why? Because the products are highly commoditized. Your memory sticks, and those from Curry's, Samsung, or SK Hynix perform essentially the same in an ordinary computer. To grab market share, everyone just keeps pouring money into new factories, advancing processes, and waging vicious price wars, what people commonly call the Eno-Hawk cycle. But things have changed dramatically in the past couple of years, so dramatically that Wall Street's elite are collectively losing their minds. The magic wand behind it all is called HBM, or high bandwidth memory. I know a lot of people get a headache the moment they hear technical terms like that. Let me use an analogy. Think of processing artificial intelligence data as moving a huge pile of goods from a warehouse to a factory. In the past, AI models were small, so ordinary memory was like a narrow country road, simple and not very wide, but it was enough. Now, large language models have hundreds of billions or even trillions of parameters. It's as if the volume of goods suddenly exploded tens of thousands of times. If we're still using that country road, no matter how fast your factory, the GPU works, everything gets stuck in traffic. That's what people call the Emery wall. So how does HEBM solve this? It's like building an 8-lane, double-decker super-elevated highway right next to the factory. The bandwidth and speed of data transfer explode, especially with the HBM4 generation that is about to enter mass production in 2026. The interface width has doubled to 2048 bits. It's not just widening the highway. It is also replacing the old toll booths with the most advanced, fully automatic electronic toll collection system. This technology is insanely difficult. The chips have to be polished as thin as paper, then stacked layer upon layer with extreme precision, like building a skyscraper, while drilling countless invisible microholes through them for electrical connections. Right now, only 3 companies in the world can master this billion-dollar microsculpture arpany. SK Hynix, Samsung, and today's protagonist, the last American player standing, Micron Technology. Micron has pulled off a spectacular comeback in this field. It skipped the previous generation entirely and went all in on HBM3E because its product excelled at power efficiency. And in those power-hungry AI computing centers, saving electricity literally means saving money. It not only secured a spot in NVIDIA's core supply chain, but also rocketed its market share from a tiny single-digit percentage to 21%, pushing the former leader Samsung down to third place. That is why Micron's financial statements now look like they reprinting money in the first quarter of its 2026 fiscal year. Revenue grew nearly 60% year over year, and the truly terrifying number is its gross margin soaring to an astonishing 68%. Ladies and gentlemen, this is a heavy asset manufacturing business. Even Apple, selling those ultra expensive XPIs, only gets gross margins in the low 40s right now. For every dollar Micron earns, nearly 70 cents is gross profit. This kind of windfall profit has driven the market into absolute frenzy, pushing Micron's price to book ratio as high as 7.7 times, and its price to earnings ratio close to 38 times. At this point, are you thinking the stock looks flawless? That's exactly where the biggest trap lies. Our ancestors had a say, a gene when something reaches its peak, decline must follow. In capital markets, especially in manufacturing, no company can sustain supernormal profits that defy the laws of physics and economics for long, unless it holds a permanent monopoly license from the government. Does Micron have that? Now let's talk about the first sword of Damocles hanging over Micron's head, suffocating capital expenditure and rigid depreciation, as we said earlier. Making cutting-edge memory chips pushes the limits of human engineering to maintain its current advantage. Micron has announced it will pour $20 billion into capital spending in its 2026 fiscal year. What does $20 billion mean? That amount could buy several Fortune Global 500 companies outright on top of that. It has received $6.1 billion in subsidies from the U.S. CHIPS Act to build megafamos in New York State and Idaho. The grand narrative sounds thrilling, but anyone who understands accounting knows this. Hundreds of billions spent on factories and equipment don't turn into revenue overnight over the coming years. They become a massive mountain on the income statement called fixed asset depreciation. That mountain is rigid. It gets deducted from profits every year, no matter how well or poorly the chips are selling. Right now, with a 68% gross margin, everyone is happy, and depreciation barely hurts. But what if? What if the market tide turns? That brings us to the second sore, the brutal capacity counterattack among the oligopolists. Do you really think Samsung Electronics, the former undisputed king of memory, will just sit back and watch Micron and SK Hynix eat all the fattest profits? Samsung did stumble badly on HBM3E because of overheating and power consumption issues, and NVIDIA even rejected some shipments. But what does Samsung have? Near unlimited cash flow and terrifying vertical integration capabilities. According to the latest industry intelligence, Samsung has completely lost patience. They have restarted construction of the massive P5 Mega, Fab in Pyeongtaek, South Korea, and even demanded that contractors accelerate the cleanroom build-out by 6 months. Samsung's strategy is brutally sim. Since they missed this generation, they'll pour hundreds of billions into the next one, HBM4, and fight to the death. Picture the scene by the second half of 2026 or into 2027, when SAMICE's enormous new capacity floods the market like a tsunami. The HBM market, which has been enjoying sky-high premiums due to shortages, will instantly turn into a red ocean of overcapacity among the three giants. When customers have more choices, they will hammer prices mercilessly. Will Micron's dream 68% gross margin survive? If it falls back to 30% or even 20%, and you still have to subtract those tens of billions in annual equipment depreciation, Micron's reported profits will go from a money printer to a paper shredder in the blink of an eye. This kind of brutal Davis double kill has played out countless times in Neomukta history. Even scarier, it's not just the supply side planting mines. The demand side is already showing signs of backlash. That's the third fatal risk I want to talk about, any demand destruction on the consumer side. When people hear AI, they picture data centers and NVIDIA graphics cards. But don't forget nearly half of Micron's revenue still comes from the stives, personal computers, and gaming consoles that ordinary people use. Right now, in pursuit of the fat profits from AI data centers, the big three memory makers have shifted most of their capacity to HBM production. That has caused severe shortages of regular memory sticks and flash chips. What's the result of shortages? Prices skyrocket, crazy skyrocketing. In early 2026, spot market memory costs jumped 25% in a single month, and some high capacity dies saw underlying costs triple or even quintuple. Downstream phone and PC makers can't take it anymore. A smartphone-to-S profit margin is already razor-thin. Now memory costs account for 20 to 30% of the total bill of materials. How are they supposed to make money? So, in order to survive, terminal vendors have adopted a desperate but deadly strategy. Stop upgrading phones that were supposed to come with 16 gigabytes of memory across the board this year. Sorry, now it's 12 gigabytes or even 8 lats that we're going to get large storage canceled when prices get so high that demand simply vanishes. Economists call it demand destruction. Once the massive consumer market, which still accounts for roughly half the business, stalls because it can't afford the prices, Micron will face the embarrassing situation of being punished by the very high prices it helped create. When the tide goes out, the traditional businesses hidden under the AI halo will shrink dramatically and deliver a heavy blow to the financials. Beyond these three fundamental risks, we also need to watch out for some non-systematic black swans. For example, Micron's management is actually facing a significant trust crisis. During the deep memory industry downturn from 2023 to the end of 2024, company executives repeatedly assured the public in open settings that consumer demand was strongly recovering. What happened? When the fourth quarter 2024 earnings came out, the Nanga flash business saw revenue plunge due to worsening demand, and the stock dropped more than 10% in a single day. Furious investors sued the company, accusing management of deliberately concealing the truth about the market. Although the court has so far dismissed some of the claims, the case is far from over. Plaintiffs are still amending their complaints and pressing forward. What does this tell us? It tells us that when the industry is riding a strong tailwind and at the peak of the cycle, management can easily fall into dangerously over-optimistic blind confidence, even choosing to report only good news to prop up the share price. So when we hear them using extremely bullish phrases like well, outstanding performance, and me far exceeding expectations again on earnings calls, as rational investors, we need to put a very big question mark in our minds and don't forget the fragile tightrope of geopolitics. As a small national champion enjoying US government subsidies, Micron's sales in China are still subject to restrictions and scrutiny, although that portion of revenue has remained stable at around 15% so far. In today's volatile international trade environment, that 15% could be wiped out at any moment as an extreme tail risk. Yet in the current valuation models that casually assign multiples of dozens of times earnings, the market is applying zero discount for that risk. After all this, let us pull all the threads together from a big picture. Long, cycle perspective, there is no doubt that the AI revolution is real, and building computing power infrastructure is a genuine hard demand. That is the core foundation, supporting the bullish narrative. However, from the perspective of corporate finance and capital cycles, Micron is currently sitting at the most dangerous point in its history, the absolute peak of windfall profits. Its perfect looking financials today rest on short-term capacity, mismatches, and temporary technical lag by competitors. It has not escaped the cyclical fate of heavy asset manufacturing. But what if this memory cycle really is different this time? We know it's possible. The prerequisite would be the accelerated real-world deployment of AI, allowing the massive early capital investments to quickly pay off. Imagine a world where most companies and most people are using AI tools every day. The market could sustain long-term high growth, and the memory industry cycle might be redefined. Frankly, given the current trajectory of AI development, that possibility is not small. Still, no matter what, catching the baton at the top of a huge run up requires enormous courage. From the perspective of market sentiment and crowd psychology, retail investors have fallen into extreme euphoria. Go look at the major stock forums. Everywhere you see claims like Micron is just getting started, and Bon, its moat is irreplaceable, when the entire market believes a stock can only go up and never down, completely ignoring risks like tens of billions in depreciation and Sampon's S counterattack. That is usually the scariest emotional top. And look at what the smartest institutional money is doing in the options market. Micron's implied volatility is sky high right now, and put options are trading at a significant premium to calls. What does that mean? It means that even though institutions appear to be riding the trend long on the surface, behind the scenes, they are sweating bullets and spending heavily to buy downside protection, ready to run at any moment. So, from a prudent standpoint, at the current price level, Micron Technology has become a pure game of faith and momentum. Its price appears to have already priced in every possible piece of good news for the next several years. For us ordinary retail investors, what is the most important thing to do right now? Control your FOMO, your fear of missing out. Don't watch others make paper profits at the top of the game of musical chairs and feel you have to jump in and catch the last hand. Always remember, on a heavy asset Micron company trading at 7.7 times book value, history has never shown a single case of a Chan-Foff landing. When the cycle turns, the speed and severity of the fall will be utterly brutal. Today, we were not going to talk about using financial derivatives to short it, because for ordinary people, shorting a momentum-driven bubble in full squeeze carries huge risks of its own. After all, the market can remain irrational longer than you can remain solvent.